This is Professor Bolt, and I want to talk to you about the exam on Wednesday. This is Exam 2, Spring 2020, and it's on chapters 3, 4, and 5. So I'm doing this one time through, so I might make a mistake or two, so my apologies if I have to go backwards and say, whoops, that was wrong. But let's get started. So again, pencil and calculator are needed, and if you don't want to bring your own calculator, of course I will have some. This exam is for 50 minutes only. We are not going to do this over 2 different classes, so you need to be prepared and ready to get started the minute you walk in the door. Occasionally students are late. It's not a very good idea because I can't extend the test taking time. If you need to do your exam in the Academic Support Center, let me know now. If you are going to be absent and it's an excused absence, please let me know now because I have a policy of a 24-hour notice for excused absences. And if you don't let me know, then there is a 20-point penalty for taking the exam late. Or if you sleep through the exam or you forget, there is a 20-point penalty. That one has been approved by the provost. As per the email, the contents are 3 or 4 problems plus 24 multiple choice and true false. And so let's talk first about some study strategies, and then we're going to talk about some test taking strategies. So the best practices for study strategies is that QSR3, sorry, QSR3. And if you want to Google that, please do. First you have, sorry, backwards. I told you I'd do this. SQR3, took me a minute. First you survey what you're studying. Then you make a list of questions that you want to be able to answer without looking at notes. And then you read, and I think you do some writing and you review, and that's where the 3 R's come from. But if you Google it, you will find exactly what SQR3 stands for. Let's talk about some test-taking strategies. You need to be ready the second you walk in the door. Focused, having a seat, ready to go, understanding that I need you to spread out, that I don't want 2 people sitting close together, understanding that you need to put your cell phone up, and if you have to leave the room for any reason, you can't take your cell phone with you, so those are just strategies for while you're there. But staying focused, not looking around. If you need a scrap piece of paper, make sure that it's a blank scrap piece of paper. It's a strong suggestion that you ensure that you are ready with those formulas, that you've gotten lots of sleep and not too much caffeine, and that you just are in a good, strong, focused state of mind. And most importantly, the more you study, the more prepared you're going to feel. And when you're prepared, then you won't be anxious or nervous or worrying about anything. So my goal is for everyone to be successful on this exam, but you're the person that has to do the heavy lifting. So problems, there will be 4 problems. The first one is going to be a multi-step income statement, and that formula is sales minus cost of goods sold, and that is equal to gross margin or gross profit. And then if you subtract out operating expenses, that's equal to income before taxes. Not every problem is going to have income taxes, but if they do, there's a subtotal there. You subtract out income tax expense to get that final net income. So that's a formula that you will need to be able to calculate. And since you're watching this video, I'm going to give you a quick tip. I'm not going beyond this little piece right here, and we're not going to have any income taxes. We're just going straight to net income. So the second problem you're going to be doing is that instead of preparing the income statement, statement of retained earnings, and balance sheet, I'm going to be asking you questions about it. So I might say, what are total liabilities given this information? I might ask you to calculate ending retained earnings. I might ask you to calculate total assets. So instead of you having to take all the time to write all these numbers out, I'm just going to ask you to give me parts of the financial statements. Question number 3 is exactly like we did on the worksheet in class with chapter 4. We were doing transactions. I sent you the key to our class worksheet, and I sent it to you by Excel worksheet. And you're going to be doing the same types of transactions. So one transaction might be a company issues stock and receives $100,000 in cash. So cash will be plus $100,000 and common stock will be plus $100,000. Another transaction might be the company pays rent expense of $200. Cash will show minus $200 and rent expense will in fact make your retained earnings go down. So you will show a negative $200 in retained earnings. We're only going to have assets, liabilities, and stockholders' equity. We're not going to go into the other parts of the income statement, just it'll save you some time. You did this on homework in chapter 3, and I hope that you will take the time to go back and review your chapter 3 homework in Cengage. The last problem that we're going to be doing in class is to calculate adjusting entries. This is going to be exactly like the ones we did in class on chapter 5, where might be an adjusting entry that says depreciation expense of $200 is recorded, and you need to show that depreciation expense is increased $200 and that is part of retained earnings, and you need to show that accumulated depreciation is increased for $200, and accumulated depreciation is a contra asset. Another one could be that there was $1,000 in the supplies as an asset and that you counted and found that there were only $200 left over. So the adjustment for this one is to record $800 in supplies expense. So supplies expense will increase $800 and the supplies asset account will decrease $800. And remember, when an expense goes up, retained earnings go down. So you will instead write that retained earnings will be decreased by the amount of the adjusting entry. If you've got any questions, go back, review what you did for class, the spreadsheet the worksheet that I gave you for class, and you did that exact same template. Okay, let's move forward to the objective questions. This means the 24 multiple choice and true false. So one of them is going to be to understand the effects of a transaction on the financial statements. You will just have done that on the problems. So as an example, whenever you record a transaction to show that money is spent to buy a building, then cash goes down and the asset building goes up. If you're showing a journal entry to record that retained earnings, sorry, let me think of something else. If you're showing an adjustment to show that revenue is earned but not received yet, accounts receivable will go up, revenue will go up, and additionally, you could say that retained earnings go up. It's going to be my judgment call to figure out which part that you put in there, and I'll make sure that it's clear. And if you have questions, you can ask during the exam. Okay, here's an example of some problems that you can go over. That's a very clear example of one type of exam question you could have that's a multiple choice. Here's another very clear and easy example. So see if you can answer those two. And if you have any questions, shoot me an email if you're not sure what the answer is to those two examples that I gave you. Okay, this is an interesting one that I have the exact same question that so many of you missed on the first exam. Retained earnings are increased by revenue, decreased by expenses and dividends. And so that will continue to be an important thing that you need to remember for the entire course. And actually when you get into finance and to other classes. Sorry, I had to stop and drink water. Next, what type of account is accumulated depreciation? Just to make sure everybody remembers it. It is a contra asset. It's an asset, but it's a negative asset, and so that means it goes against the regular assets cost. Three definitions that I think would be important for you to know. You need to understand that accrual accounting is a method of accounting where you record and recognize revenues when earned and expenses when they match with the revenues, regardless of when the cash exchanges hands. The matching principle is the accounting principle that says that you should match your revenues and expenses in the right accounting period. The definition of depreciation, to make sure everybody gets this one right. Okay, make sure you've got that definition memorized for what is depreciation. The accounting cycle. I sent out an email message, and I'm hoping that all 70 of you look at the emails carefully, because I do those hoping that that gives you some good strategies and tips for the exam. So in the accounting cycle, a company has regular transactions. That means that companies earn money, pay expenses, buy equipment and buildings, pay their bills, borrow money, shareholders contribute cash. So those are just your regular day-to-day transactions. Next, if we're about to prepare financial statements, we're going to record adjusting entries. And these adjusting entries are done to make sure that the accounts are updated so that they're correct and accurate, because there are some updates that need to happen. For example, if supplies are used, or if depreciation needs to be recorded, or if we forgot to record an accounts receivable or an accounts payable. Next, the financial statements are prepared. There are 4 of them. We've studied them extensively. And after that, closing transactions. And just as a reminder, closing transactions are a little odd. They're only done one time in the accounting cycle, and that is at the very end, and it is to close revenues, expenses, and retained earnings, and they are closed as their own separate account, and the balance is transferred into retained earnings. Now, lots of times when we're doing transactions in class, I show the effect on retained earnings, but you don't really show the effect on retained earnings until closing occurs. And then all of their revenues, expenses, and dividends are transferred over into the retained earnings account. And then now you've finally gotten everything to balance. So there's the definition of closing entries right off the top. Let's look at a few more things in here. We've got periodic versus perpetual. This is something we'll be talking about in class on Monday. These are 2 methods of calculating inventory. Now we're talking about inventory of, for example, of Walmart or any type of store that sells retail merchandise. And so most companies keep up with their inventory day to day, every single transaction. Oops, sorry. Let me pause. Sorry, I had to get a quick glass of water, and when I did so, it makes the screen do some strange things. So let me go back to the account that we were sharing. There we go. And make myself disappear, make my office disappear. Perpetual versus periodic. Okay, a perpetual inventory system is one where every single transaction, the inventory is reduced, and every time they buy inventory, inventory is increased. So there's a perpetual count of what's going on. A periodic inventory method is one where you have to stop at the end of the period and literally count to see how much inventory is left over. This is a little bit old school. Not many people do it, but let's take an example of a landscaper. That landscaper is probably not going to keep track of how much fertilizer and pine straw they have in a shed, but they might have to keep a periodic count so that they can say, well, this is how much I bought. Let me count to see how much is left over so I can see how much I used. And we will give examples of that in class on Monday. Also Monday, we'll be talking about the 3, well, we've already talked about the 3 product costs of a manufacturer. So a manufacturer has materials, and they have labor, and they have overhead. And we talked about the fact that that's a little bit quirky, But those are the three costs associated with a manufacturer. We actually talked about the three inventories. It's not on the exam, but I don't want to confuse anybody. Three different types of inventory in a manufacturing organization are materials, work in process, and finished goods. And you'll be talking about these two things much more extensively when you take BADM 212 for those of you that are going to take it the next course. Okay, moving along, a lot of this is some old stuff. Cost principle. We know that we use historical cost, that we do not record fair market value of accounts every time we prepare financial statements. So whatever we pay for anything that goes on our balance sheet, whether it's a piece of equipment or supplies or inventory, there's a lot of exceptions, but generally historical cost is going to stay on there. So you're not constantly adjusting them for changes in values, because as you know, and as I know, real estate prices come and go, stock prices come and go. There's all kinds of crazy things that can go on in financial statements. We'll talk about those if you take a future advanced course. Revenue recognition, important rule that everyone needs to remember. Something we've done in the prior chapters. You recognize revenue when earned, not when the cash comes in. So frequently, a company will do work and record the revenue as an accounts receivable, and it doesn't matter when the cash is received. The matching principle, accrual accounting, says that the principles of revenue recognition show that we record revenue when earned. Probably 3/4 of the class is going, yes, you say that all the time, but there's about 25% of you that are still having challenges with that, specifically when we come to applying this to a scenario. Okay, moving forward, purchase discounts. These are purchase discounts, and I need to put sales discounts in here too. A sales or a purchase discount is whenever there's a reduced price because someone pays early. So we talked about in class on Friday a sales discount. That means that you have a customer that gets 1% off for paying early. The exact same thing can happen to your business when you're making purchases yourself. So let's see if I can make it a little more clear. I don't think that was as helpful as I'd hoped it to be. Let's say that I own a business and my business sells furniture. And I have a big showroom of furniture in there, and I buy my furniture from North Carolina furniture factories. And North Carolina furniture factories, when I make these purchases, will give me a discount if I pay early. I will record those purchase discounts in my accounting records. Similarly, I may have a customer that comes in and buys a whole house full of furniture, and I will give them a sales discount if they pay me early. So I may say, by the way, if you pay me within the first 30 days, I'll give you 1% off on the cost of this furniture. So those are the differences in sales and purchase discounts. There are, I think, about 7 or 8 true-false questions. They're short. They help me to see if you understand just basic things that you need to memorize. So, for example, the fact that sales returns and allowances and sales discounts, these are contra accounts, contra revenue accounts. And they make your sales go down. And these are the types of accounts that show that you might have sold $1,000 worth of an item, and that might be the revenue that you record. But if you have a customer return something, that revenue is going to go down. If you give an allowance because then maybe there's a dent and scratch sale or it's damaged, revenue is going to go down. If you give the customer a discount for paying early, revenue will go down. So these are contra revenue accounts. And these contra revenue accounts reduce sales. Gross profit ratio is a calculation that we're going to talk about in class on Monday. And it is calculated by taking the gross margin. Remember, that's also called the gross profit, divided by total sales. And sorry if it's confusing, but gross profit and gross margin mean the same thing. Different textbooks, different financial statements will use margin, some will use profit. But the gross profit margin says, what percentage do I get to keep of each one of the items that I sell? So if I'm selling, let's say Walmart, I think Walmart's gross profit margin is around 20%. So that means that on average, if you buy something at Walmart for $1, they get to keep 20% or 20 cents. It costs 80 cents for the product. And finally, it looks like we've got a duplicate, so I can delete this one. Best wishes for you as you're studying, and please email me if you have any questions. I appreciate as many questions as you can provide to me. It's really helpful, and I appreciate it if you could send them all to me at once. Every now and then I'll have a student that sends 10 or 11, one after the other. So try to accumulate them and send them to me early. Just like studying early is the best practices for you. And we'll talk about this a little bit more in class on Monday.